Hey everybody, welcome back to the channel. Okay, today we've got to talk about something very, very important. As you can see, it's important because I have a pen in my hand, and when I have a pen in my hand, that means I've been taking some notes, and the pen just fell because these things are extremely important to talk about. Bill Ackman. Bill Ackman, legendary investor. We're going to get into this video today a little bit about his history for people who don't know who Bill Ackman is. And we're going to talk about his warning for 2022 and what he predicts will be a black swan event in which something out of the ordinary is going to happen. And in his opinion, it will be a market crash, which he has been right about in the previous two times where he has made money off shorting the market. But in this case, it's a little bit tricky to figure out, is he going to be right? Is he not going to be right? How is he logically justifying this? You know, when Bill Ackman speaks, I tend to listen, not because I think he's correct about everything or I'm obsessed with him or I trust him as an investor over someone like Kathy or Warren or anything like that. But he's one of those people that has a lot of logic when he does speak. Whether he's right or wrong, or whether you always agree with him, there is logical foundation behind the analysis that he provides. And sometimes he ends up being massively right, as he did with the pandemic and 2020, which we'll talk about in a second. And sometimes he's wrong. So I want to talk about today the history of Bill Ackman and why he thinks a crash is coming. Couple of quick facts. He has beaten the S&P 500 by 8%. So he's average return since 2004 for 16.9% per year compounded annually. And the S&P has done about 9.6% since that time. So he's beaten the market almost by double every year. So the guy knows what he's doing in terms of hedging and betting investments, right? Some years are worse than others, but nonetheless, 16.9% per year on average, not bad. March 2020, when he went on CNBC and he told the president to shut everything down, he was getting a lot of media attention because he turned $27 million of a hedge on the market to $2.6 billion as a result of the pandemic. They had a lot of long positions in equities that were ultimately failing, right? Like Hilton, hotel companies, obviously those stocks were going down. They put a hedge. A hedge means they shorted the market, and in a basic description, when you short the market, that means you make money by making a bet that the market will go down. They made such a monumental hedge to the tune of $27 million that even though their long equity positions within certain stocks decreased dramatically, the hedge was so substantial that they turned $27 million to $2.6 billion, and then they were able to take those $2.6 billion after exiting that short position and dump it into the companies that got destroyed by the pandemic. So it was a phenomenal move just in terms of pure business because they were able to take $20 million, turn it into $2 billion, and then take all that money and then dump it into these stocks at horrible reduced prices because of the pandemic to only make their long positions even more substantial because they were able to buy these stocks at such undervalued prices. He is also an activist investor. And this is the one thing to understand about Bill Ackman. If you've never seen a documentary on him, I think there's one on YouTube. I'll try to put it in the description if I find it, which is about Herbalife. Herbalife is, in my opinion, a multi-level marketing company, an MLM. For those people who don't know what MLMs are, they're pyramid schemes at the end of the day. They don't sell you anything. They sell you something in which you can sell other people things, and the real value comes from you selling other people on the thing versus actually selling a product or service. Bill Ackman is an activist investor, and an activist investor is someone who wants the public to recognize that these companies are doing bad things, and MLM is obviously a very bad thing, and they short those companies. And if you short those companies, that means if you can get the public to recognize that these companies are bad, that they are MLMs, that they are frauds, and you have a massive short position, then the stock price dramatically drops, which means you make a lot of money on the upside. This is what happened with GameStop and AMC, or what was supposedly supposed to happen with hedge funds shorting them. But obviously, because the public and Wall Street bets and the stock groups got to know that this was happening, they revolted and they were able to rally together and get the stock price to go up. So there is a lot of activist investing involved in a lot of different sectors of the market. And Bill Ackman refers to himself as an activist investor, even going by so far to say that he was ready to donate all the profits that he was making off of his Herbalife short, because he knew that if he could donate that money, that means that the public couldn't say that he has a financial incentive to get people to recognize that Herbalife is a bad company or an MLM. They would actually be listening to him just to listen to him, because if you're donating all the profits, then why would you go through all the time and energy to like create a massive movement against this company and short it when you are not even going to get any of the benefits of that? Now, the reason I think he did that is because ultimately you get more attention, right? So like, even if you donate the $100 million you would make off that short, if more people believe in you and trust in the words that you have to say, your reputation increases. So the next time that you actually short the market because you were right on the MLM thing, that means people are going to listen to you. And that time you're actually going to make a lot of money when you choose to do something in an activist sense because you're not donating anything. So he's been a very strategic person in terms of how he's done certain things. Now, Herbalife the public didn't agree. They didn't think it was a fraud. They didn't think it was an MLM, and he ended up having to exit that trade in the red, not making any money off that short. Even though if you watch that documentary, it's very obvious that Herbalife is an MLM. So sometimes it doesn't work out. But he's not right all the time. He's not always going to be financially right all the time. But this is a guy who's been involved in the market for a long time. Now, he particularly hates what's going on with inflation. And that is his ultimate argument for why the stock market is going to crash in 2022. Couple of unique things here. In October, he gave a presentation to the Fed in which he said we need to raise rates. And there were a couple of reasons for this. Number one, the government has printed about $5.1 trillion in the past year, which accounts to 25% of GDP. So 25% of the gross domestic product that the United States has released has been printed in the past year at the tune of $5.1 trillion, which was absolutely insane. He said that the Build Back Better plan, which didn't end up getting passed yet, but has the potential to get passed if Biden somehow pulls it off, increases another $2 trillion over the next 5, 6, 7, 8 years of more fiscal policy and more irresponsible spending from his perspective. So his argument is that we're spending way too much money, we need to taper, and we need to increase interest rates. If you increase interest rates, you naturally destimulate the economy because it's harder to get money because the cost of borrowing money becomes harder. So that means consumers are less likely to borrow money. That means businesses are less likely to borrow money, which means less money gets pumped into the economy, which is a good thing when the value of your dollar is inflating at such a level in which you need to ultimately deflate it. This led him to ultimately create a short position on the market. Now he's doing something where he is shorting credit. He's doing two things: credit default swaps and then put swaptions, which in layman's terms, or he's betting that interest rates are going to go up. And as a result of interest rates going up, his swaptions that he has on those interest rates going up mean that the market is going to go down, which means he's going to make a lot of money if he's correct that interest rates go up. And if he's not correct that interest rates don't go up, then he's still not going to lose that much of a money. So it's a very strategic type of hedge that he has. And if they do go up, if there is that type of black swan outlier event, he will end up making a lot of money on shorting the market. A couple of tweets I want to read that are really important to talk about when it comes to Bill Ackman and his investing philosophy. He said that reported inflation is understated. The owner's equivalent rent, the OER, relies on owners' surveys to estimate inflation housing costs. This is an extremely imprecise metric, so he doesn't believe the inflation metrics that the government or other surveys have provided. The single-family rental market provides more accurate data. OER in today's reported core CPI was 3.5% year over year. He then said the largest owners of nationwide single-family rentals are reporting 17% year-over-year rent increase. OER is 30% of the core CPI calculation and 24% of the reported CPI. Using the more empirical research in the calculation increases today's core CPI from 4.9% to 9.0% and CPI from 6.8% to 10.1%. So CPI is more for consumers, OER is for owners' equivalent rent, and he says both of those metrics that have been reported by the government are totally false because there's other variables that you have to consider in terms of how inflation is increasing. He then said housing inflation is unlikely to abate based on supply and demand trends. The inflation that households are actually experiencing in terms of the money they have to pay for their rent year over year and for the natural goods that they have to buy, like milk and toothpaste and stuff like that, is raging and well in excess of reported governmental statistics. Some other main factors that he's saying that are going to be bad for the market are weakening China growth, emergence of new COVID variants. We've seen that with Omicron. Second order impacts from supply chain constraints. This is the stuff that Kathy's been talking about, why there's going to be a freer recession because of supply chain constraints, geopolitical risks, and obviously cybersecurity risks. Those things are kind of macro level. They're involved in most economies year after year. The big thing is he believes that the Fed is underreporting inflation. And because he thinks inflation is not transitory, and because he's been right on some other occasions when he's found things that are going on in the market that are obvious to see if you do the research to see, like buying Palantir stock, that's my opinion, not financial advice, but it's pretty obvious that they're going to be pretty big, then you can make a lot of money when you see things that other people don't see. It's kind of the fact of life. Like if you see things that other people don't see and you take bets and actions based on the things that you see that other people don't, you have a much higher potential of profiting off of those things if you're right. Now, is there a chance you're wrong? Absolutely. But if there is a chance that you are right, then there is a big, big chance you are right. He's been right before in certain situations. With inflation in today's market, he does not think it's transitory. He actually thinks it's being underreported because of core metrics that aren't really evaluating the key variables that need to be evaluated, which means the 6.8% CPI index for inflation that was reported back in December or early December is actually 10.1% if you factor in all those other different variables, which means the cost of your dollar is decreasing by 10%, not just 6%. And that's only going to get worse if the Fed doesn't stop printing the money and if they continuously leave rates unchecked and don't increase the rates. Because when you increase the rates, you at least have a chance to check back against inflation. If you don't, then you have no chance. So that's basically his argument. And he's already disclosed that he has a short position on the market and he's waiting for rates to go up and he's waiting for a market crash to happen. Now, how bad will the market crash be? How long is he going to keep this position? We don't know, because there might be a day where he's like, I think I'm wrong about it. I'm just going to get out of this. But if he's right about this, and if he actually sees something that the rest of the market doesn't see, and he thinks that the S&P is way overly valued, he thinks the NASDAQ is way overly valued, he thinks a lot of these stocks that are growing while Kathy's stocks are decreasing, all of it is messed up, and there's like a wonky thing going on in the market in which the Fed is artificially creating liquidity in order for the stock market to be at the levels that it's at, which are all-time highs, by the way, and they're getting higher and higher as we get into the end of the year of December 2021, then it's really going to be interesting to see if 22 it's just going to keep going or there's going to be a massive correction. My opinion, I don't know. I think I'm learning more about the stock market. I don't want to give a definitive answer on what I think is going to happen. What I do think is going to happen is, in general, I think that we're going to be flat for the next couple months. I don't think there's going to be massive exponential growth, especially with inflation still being a concern and especially with interest rates likely going to be raised by March. If that's going to happen, then I don't think there's going to be a massive bull market happening anytime soon. But again, there can be outliers. A lot of different things can happen. Geopolitical risks can occur, and there can be something unique that happens. But this is why Bill Ackman thinks that inflation is going to be one of the major leading causes. And it's not that complicated. His argument is very simple. He's like, there's too much inflation. Most people don't recognize it. I'm shorting the market because I think this inflation is going to get really bad, and I'm going to make a lot of money off that short. Will he be correct? I don't know. I guess we are going to see what happens. Let me know what you guys think about Bill Ackman's strategy. Are you shorting the market? Do you think it's, do you have the stomach to short the market in case the market goes up? Or do you think you're going to hold true to your convictions because you agree with his philosophy that inflation is bad and if we're not going to do anything about it, then the market is going to crash? Let me know your guys' thoughts. Looking forward to reading the comments. My name is Mitt. I'll see you in the next one.